one, our second largest presentation at RIU, is they're bucking the trend because they're actually giving back to their investors, and they have been for the last couple of years. Horizon is a low-cost oil producer, highly leveraged to the oil price and generating strong cash flows from a portfolio of assets across the Asia-Pacific. And having recently commissioned a significant new field development, the company has materially increased production with further growth plans to follow. Horizon is committed to optimising production from its portfolio with a focus on you, their shareholders. Would you please welcome Richard Beaumont, the group's CEO?
Well, look, thank you very much. Look, I'd like to think that we might have saved the best till, well, almost last. Look, you've heard a lot over the past few days of companies with aspirations to discover, develop and fund new oil field developments with the hope that one day investors might just receive a return and hopefully some dividends or distributions. Well, at Horizon, we're just not living a dream, it's actually a reality. Here's a company generating strong cash flow from its assets, importantly, still investing in its portfolio, but most importantly, delivering significant returns and surplus cash back to shareholders. So let me take you through the story. And whilst, before I do that, please note that everything I mention here is generally US dollars, so real dollars, unless otherwise stated. So we've got our usual compliance statement and disclaimer, which I'd encourage you all to read. So on to who we are. Well, look, Chrissy's already mentioned, we're a low-cost oil producer. We've got two core assets, the Maori field offshore New Zealand, where we have a 26% non-operating interest, and Block 2212 in China, where we have a 27% or just under 27% non-operated working interest. The two fields combined are generating about 5,000 barrels of oil per day net to Horizon, which is about a 40% uplift on the FY22 average, and we're throwing off significant cash flow. So net cash at FY22 year end was just over $40 million US. And as Chrissy mentioned, we've got a history of returns to shareholders, and that's core to our strategy. So our strategy is pretty simple. First of all, we aim to maximise cash flow generation from our existing assets. We're focused on shareholder returns and making further distributions when it makes sense. And we'll continue to invest in production growth, focused firmly in and around our existing assets, but keeping an eye out for any exceptional new business opportunities. And most importantly, we're delivering on this strategy. So in FY22, we generated significant cash flow with EBITDAX of over $73 million US, or over 100 million Aussie dollars. Our ability to generate such significant cash flow is really underpinned by a very low operating cost, under $20 US a barrel. It's that sustained free cash flow generation which has enabled us to return significant amounts of capital back to shareholders. We delivered over $70 million US, over 100 million Aussie dollars in distributions during this year and announced for this current financial year. That's 3 Australian cents per share for 2 consecutive years running, and represents about 40% of the company's current market cap. So that's a roughly 20% distribution yield per annum for the last 2 years. And notwithstanding these distributions, we're still investing in production. We brought online during the year our first big new oil field development in about 8 years, with the 12-8 East oil field in China. This field has added significantly to our production, and I'll talk about that a little bit later. But we're not stopping there. We're continuing to invest in production growth, and in fact, we've got some wells which are being drilled as we speak. As I mentioned, all of this has led to some great success in production growth, and we're currently producing more than 40% higher production levels than we were for the FY22 average. Now, in terms of Horizon as a snapshot, here's a bit of a story on our share price history. You can see pretty clearly, you've got the oil price in the green, Horizon's share price in the orange, and the ASX 200 energy index in the grey. You can very clearly see the linkage and leverage to the oil price, but importantly, we're outperforming both the ASX 200 energy index as well as the oil price. And that's really underpinned by that strong free cash flow generation and the returns we're delivering to shareholders. I won't go through the detail of this slide, but here's really a snapshot of all the key highlights from FY22. We had significantly stronger financial results with a 70% increase in revenues, 100% increase in EBITDAX, 200% increase in net profit after tax. And all of this drove significant cash flow generation, enabling us to return money to shareholders. We also were able to extend our existing debt facilities with our senior lenders ANZ, Westpac and ICBC, again showing the quality of the assets in what is a more challenged financing market for the sector. Operationally, I've mentioned the successful completion of the 12-8 East project. Impressively, first oil from this project was delivered within 18 months of FID, notwithstanding the pandemic and the various global supply chain challenges. On ESG, despite the elevated activity levels, we're operating very, very well, and we're significantly better than industry benchmarks. And on climate change, we declared our ambition to reach net zero by 2050, and we're developing a roadmap to achieve this. So now turning to the assets, starting with Block 22/12 in China. Our production comes from 25 wells spread across the fields here. Historically, production's been concentrated in and around the 6-12 and 12-8 West fields, where we've had production over the past sort of decade of around about 8,000 to 10,000 barrels of oil per day. And that production's been largely sustained through various initiatives, infill drilling and so on, in order to sustain production levels. During this year, we brought online the 12-8 East field, which is here in the bottom right, and that's really transformed the field. So production rates have lifted from that 8,000 to 10,000 barrel average up to over 15,000 barrels a day gross over the last month. That's really a game changer for us in terms of free cash flow generation, and we're not stopping there. In recent years, these fields have generated around 70% of our cash flow, owing heavily to the very, very low operating costs, which are less than $13 a barrel. So a little bit more on the 12-8 East development. Here we've got a 3D graphic really showing the core elements of the development. We've got 6 producing wells into the various reservoirs and 1 water disposal well. And the development includes a leased self-installing wellhead platform, which is tied back to the existing infrastructure, the 12-8 West platform. As mentioned, we brought on the project in April this year, with Horizon's share of development costs on time and in line with the original budget of around $20 million. Following cleanup flow, these fields have contributed around 9,000 barrels of oil per day gross throughout the last month. And we expect that's going to decline down to an average for the first full year of around 4,000 barrels of oil per day. We're highly encouraged by the initial production results, and should we continue to see the continued strong production performance, we'll likely look to further development of what is quite a large resource. Now, this map shows the various additional infill exploration opportunities in and around the block. And so again, you've got all of these 3 sort of production hubs, and you can see the smattering of multiple additional opportunities, which are in easy tieback reach to our existing facilities. Importantly, I mentioned we're starting to drill additional wells already, and we've started with the M3 well, which is currently drilling ahead, and it'll be followed by the North well. As part of this sort of expansion program, we've also conducted a multi-well workover program, which has just been successfully completed, again helping us to sustain these strong production levels. Now, looking to the sort of our outlook on the asset and a bit of history, this sort of shows, the sustained production levels we've been able to achieve over the past almost decade. And the green section here is really our existing 2P reserves profile from the asset. This blue section is really the additional production potential to be unlocked by developing our contingent resources and prospective resources in the block. Importantly, the 12-8 East development has really initiated this kick up in production. And as I mentioned, we've got infill drilling underway, which will help us to sustain and continue to unlock this value. But this is really where the potential lies in the block. Looking at our other asset, the Maori asset continues to be a strong asset for the group, generating about 30% of our cash flow. Importantly, the production decline rate here has been heavily arrested by continued water injection into the field. And production rates here are largely sustained without the need for significant CapEx spend. On operating costs, again, it's fairly low or modest in the context of the current oil price. And Maori crude attracts very high premiums to Brent. We've got some planned workovers here. We're impacted by COVID, but we're getting onto them now, and we expect production rates to lift over the coming months. Similar to the chart I showed you on our China asset, this one also shows the production history. And importantly, you can see this is really the future. You can see that the production levels are heavily sustained without really that big decline rate, again, driven by the water injection into the field. Our focus is to produce at least out to the end of the permit life, with the option to extend being actively investigated. And there's further contingent resources we're looking at potentially unlocking through infill drilling over the coming years. So in summary, look, Horizon's had another very strong year in delivering significant value to shareholders, and the outlook looks pretty rosy. We commenced FY23 with very, very strong production rates, which again bodes well for strong cash flow generation. As I mentioned, we've got current daily production at over 5,000 barrels of oil per day, up by 40% on FY22, which was already a very strong year. To sort of put things into context, we're generating about $500,000 daily in revenues, and that's up from about $300,000 a day in 2020 or FY22. Now, whilst we don't expect to sustain these production rates from the current well stock, initiatives such as the infill drilling I've mentioned are really all about trying to sustain those production levels and bring on additional production growth. We're determined to continue to deliver value to shareholders, having returned almost 50 million Aussie dollars last year, and again, another $50 million in returns this year. In terms of new business, our focus is on our existing assets and unlocking the remaining value, but we do keep an active watch on new business opportunities, but they've got to be a compelling proposition where we can continue to look to provide further distributions to shareholders. Whilst everything's not easy in the sector, we've got ESG pressures, supply chain challenges. We've got a very talented team, and we look forward to continuing to develop and unlock shareholder value. Thank you.
Well done. Great end. Thank you so much, sir, for winding us up there with our investment potential and possibility. Now,